I just did a video price to sales or using the price to sales ratio. And currently that's right around 3.2-ish. And the peak of the dot-com bubble, it was 2.87. So there's a lot of metrics that you can use that would say that not only are we in a bubble in the stock market, but it's one of the biggest bubbles we've ever seen. So I don't think that's really debatable as far as the valuations being at nosebleed levels, but that doesn't mean that it can't triple from here.
Right.
Like for me, it's a little bit easier to determine what's happening with the economy. And I think it's slowing down. And my main reason for saying that is the labor market.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. The stock market's back in party mode since zooming back to all-time highs in the wake of the April Liberation Day lows. Now, the Fed just cut its policy rate for the first time this year, and it's guided that more rate cuts likely lie ahead. So, can the bulls remain in charge and keep powering asset prices higher into 2026? Or are the many potential risks, not the least of which is a slowing economy, more likely to bring an end to the party? To discuss, we've got the good fortune to welcome George Gammon back to the program. George is best known for his financial education media endeavors, most notably his George Gammon and Rebel Capitalist YouTube channels. George, thanks so much for joining us today.
Thanks for having me. I'm super excited to dive in. We got a lot to talk about.
We do. It's a real pleasure. Looking forward to seeing you in person in, I think, just a little bit over a month at
Yeah,
Brian
New
Lyndon's
Orleans.
New Orleans conference. If anybody watching is going there in person, George and I look forward to meeting you guys in the halls there. But George, since it's actually been embarrassingly long since I've had you on the program, so I'm sure many viewers are familiar with you. But for those who aren't, let's just kick it off with a question that I used to ask a lot. I ask less recently. I ask less these days, but I think it's important here to introduce your way of thinking to people.
Yeah.
What's your current assessment of the economy and the financial markets?
Well, I think those are two different questions, right? Unfortunately, I mean, I
Yeah.
wish they were the same question, but they're not. The stock market should be a reflection of what's happening in the economy, but I think often there's an inverse correlation,
Hmm.
which is what I think we're seeing right now.
Yeah.
As far as the economy, because the stock market predicting whether it's going to go up or down, I mean, who knows, right? The only thing that we know is it's in a bubble. I just did a video price to sales or using the price to sales ratio. And currently that's right around 3.2-ish. And the peak of the dot-com bubble, it was 2.87. So there's a lot of metrics that you can use that would say that not only are we in a bubble in the stock market, but it's one of the biggest bubbles we've ever seen. So I don't think that's really debatable as far as the valuations being at nosebleed levels, but that doesn't mean that it can't triple from here.
Right.
Like,
Right. The
we,
big question is when will it matter, if ever? Yeah.
right, exactly. So for me, it's a little bit easier to determine what's happening with the economy. And I think it's slowing down. And my main reason for saying that is the labor market and these, I know you've talked about this on your channel, these huge revisions. I mean, it's not just the monthly revisions where June, we start off at 147, which headline, okay, everyone's celebrating it. But then you fast forward a few months later and, oh, sorry, it's at negative 13.
It's negative. Yeah, exactly.
And then we saw the benchmark revisions for April 2024 to March of 2025, and almost down 1 million jobs.
Yeah.
And within those benchmark revisions, you had a couple months in 2024 that were negative as well. And I get the whole immigration argument that we don't need more jobs or we don't need as many jobs because we have so many people leaving the country. But I don't really think that's a valid argument if you look at it through the lens of the economy.
Hmm.
Because look, if we have 100 million people leave the United States and we lose 100 million jobs, okay, that doesn't impact the unemployment rate because the labor force participation goes down by the amount of the job loss. But is that going to impact the economy? Of course it is.
Absolutely. Yeah.
Of course it is. So I try to look at things in terms of the job growth, whether that's positive or whether that's negative. And even going back to that immigration argument, I don't know how that would have impacted 2024. because we had negative non-farm payrolls back then when you look at the benchmark revisions. So what I did, Adam, is I went back to the 1970s and I tried to find times when we had a negative non-farm payroll print when we weren't in or around a
A
recession.
recession.
And it's pretty rare. It's pretty rare. And usually what you see is it's a result of some sort of weather event or some sort of massive strike. Like if,
Mm-hmm.
Walmart, if all their employees go on strike, you see a huge drop down to where it's negative, and then you see kind of a bounce back right back to where it was after the strike is over.
Mm-hmm.
So what I always say on my channel, and I know you really not only say this, but I think a lot of your guests echo this, is that there are no certainties that we're dealing with. We're dealing with probabilities. But when you look at the labor market and you look at the revisions, you look at the negative non-farm payrolls, you look at what has happened in history, you combine that with what's happened with the yield curve, with the inversion, the uninversion, and usually that's when you have a big problem. I think the odds have to lean in favor of an economic slowdown. Now, whether that's just a slowdown in nominal GDP or whether that's an outright recession, I don't know. We'll see. I mean, my base case would probably be recession, but then you have to rely on the NBER and what they consider a
Mm-hmm.
recession. And as far as the average Joe and Jane, having the ability to put food on the table or a roof over their head or their ability to get a job, I don't think they care about what the NBER would define as a recession. So that's where I'd start with the economy. As far
All right.
as,
And sorry,
go ahead.
before you get to the markets, I'd love
Yeah.
to get your opinion on this, given your last point there. Um, so we have had this increasing K-shaped economy, right, which
Yeah.
I'm sure you've heard about, right? Um, where the averages still look pretty good, right? But it's because you have the top part of the K who is doing better and their spending is making up for a drop in spending on the lower half of the K who are doing increasingly worse, right? And as time has gone on, the top half of the K has gotten smaller but richer, and the bottom half of the K has gotten bigger but poorer. Um, and so I guess my question to you is, th- does the line of recession, not in terms of the technical definition, but the terms in which the majority of the populace just feels like, hey, I'm actually now really struggling.
Yeah.
Has that line changed over time
Oh,
because we have such an
absolutely.
imbalance? Yeah.
Absolutely. I think it has. I mean, I think that's why Trump got elected, or one of the reasons why he got elected is because people were sick and tired of their purchasing power going down and just struggling more and more and more. And yes, so the top
Right.
1% or the top 5% are propping up the economy with their addition to aggregate demand that's making up for the lack of aggregate demand for the other 95%. But that really goes back to asset prices. And that's about the
Right.
housing market, which is deteriorating. That's about the stock market, which it is at all-time highs. How long can that last? I think that goes back to passive investing. I was fortunate enough to spend a week with Mike Green about, in St. Bart's maybe 3 weeks ago or so.
Oh, great
And
guy, great place.
yeah, that's right. We were at Hughes' place out there, and we had a lunch, and we sat there and talked for about 3 hours. And we were going over, Mike's passive thesis, but
Yeah.
we were going into
Giant
it.
mindless robot. Most of my viewers are pretty familiar with his
Yeah, we
framework.
really went into a deep dive there. And I said, Mike, do you have any models that would try to predict when we go from net inflows to net outflows? And he goes, yeah, I actually do. And he said it's all around the labor market
Yeah.
and the unemployment rate. He says once it gets up to maybe 5.5, is that's when I think it might get concerning. And then we started talking about AI and how
Mhm.
even if we don't go into a recession, how AI could very well in the short term bump that unemployment rate, let's just say up to 6 or 7%, especially with the white collar jobs. And those are the people who usually would be dumping the largest percentage of their paycheck into the passive flows. So if you see that go up for whatever reason, you could see that passive switch, and that's the catalyst there where the stock market goes down, and all of a sudden that aggregate demand from the top 5% just evaporates very, very quickly. So I'm not saying that's my base case, but I'm saying I think that's a risk that should be on people's radar.
Radar. No, I totally agree. I want to talk to you a little bit more about that. I've got that here in my notes because it's such a big driver. Um, but to your earlier point about the growing frustration, I think the an increasing number of the populace is feeling is, they're being told, hey, look, GDP is 3% plus, stock market's at all-time highs, housing market still all-time highs. I mean, we're seeing weakness in an increasing number of markets, but still the average. And this is sort of my point, where if you look at kind of the headline numbers, they can tell a story of everything's just fine. But to an increasing amount of the majority, it's like, no. And I'm tired of you telling me
Yeah.
that everything's fine,
Yeah.
right?
Yeah. I
Yeah,
see it in my comments all the time.
yeah, and I think it's because that line of recession really has moved, even though our technical definitions of it haven't. And so
Mhm.
more and more people, even when things are going a-okay, are not a-okay. Yeah.
Yeah. Yeah. And I think it's just Wall Street focuses on those things that you mentioned, the Fed dropping rates, GDP, where the average Joe and Jane, I think, focuses and has their finger on the pulse much more so on what's happening in the labor market.
Yeah. And I mean, the labor market is the key for all the reasons you just mentioned. And, I'm sure you're familiar with guys like Michael Kantrowitz and his HOPE framework. And, E is that last bulwark
Yeah.
between uh, not recession and recession, or growth and recession. So we'll look at it really closely. But I think that is what forced Powell to pivot here at Jackson Hole, where for all of this year, he had been saying, the labor market's cooling, but that's a good thing. It was too hot, and we see this as normalizing, and there's nothing to worry about here. And as time went on, an increasing number of the journalists at his press conferences would say, well, Chair Powell, that's not really measuring what I'm hearing from folks in the real world. And he was like, no, no, we're still not worried. And then all of a sudden on Jackson Hole, it was, ooh, oops, actually looking like this labor market's weaker than we thought, right? And I
Yeah.
think because at the end of the day, it is that key linchpin. And in the we're talking like an hour or so after the FOMC released its guidance for August. And the Fed did change, and they're saying, hey, we now think the balance of risks is that the labor market is going to continue to worsen from here. And therefore, we expect to have to do more rate cuts going from here. And I'll mention one last thing, and I'll let you resume your course here, get into the market side of things. If you look at the history of rate cuts, and I'll see if I can pull up a graph here real quick, George, that'll make this a little clearer for you.
Sure.
But if you map um, the unemployment rate to recessions,
Mm,
and then you map the federal funds rate on top of that. So right here we've got the unemployment rate in blue and the federal funds rate in red.
yeah.
You'll see here that every time the unemployment rate has trended down and found a bottom and
Yeah.
started to increase again, it
Yeah.
then shoots up, right? And it
Right.
shoots up really right into the next recession. And of course, these
As the
recessions,
Fed is cutting, by the way.
well, that's what I was going to say. So first, just on the unemployment rate data alone, you see that once it bottoms out and starts rising, it then tends to spike in the next recession. Very
Right.
similar pattern with the federal funds rate, which is once the Fed goes through a hiking regime, plateaus, once it starts to cut, it's generally right then when the next recession arrives and the Fed is kind of panic cutting all the way down there. So
Mm,
we can see here right at 2025, we're kind of right at the cusp of those two trends
yeah.
yet again. And so you have to ask yourself, what is different about this time that would avoid the same fate that we've seen at almost every other similar cycle in the past 75 years?
Yeah. And when I see this chart, I've never really pulled up this chart specifically, but I look at this through the lens of the yield curve. Because what you're seeing there every single time you see that red line drop is you're seeing the curve go from inverted to uninverted. And you're
Hmm.
seeing that happen as a result of a bull steepener. And so you would see a very similar chart where once the yield curve, let's say twos and tens, once they uninverted and really started to steepen out, you would see the unemployment rate spike right there. And that's because it's steepening out because of exactly what you're seeing in the chart, is
Yeah.
that's because the Fed funds is dropping.
So I guess my question to you, and then I'll let you run on, is do you see anything this time that is a convincing candidate to you that it's different this time and we're not going to go through that because of X?
No, because I think the argument that you could have had there for the yield curve was it was all about issuance. So the only reason the curve was inverted was not because the bond market was predicting lower nominal GDP growth. It was only inverted, excuse me, because they were issuing so little at the long end of the curve.
Hmm.
And it's all about supply or supply expectations, or however you want to look at it. Where for me, and I'll be getting into this in a moment, the interest rate, especially at the long end of the curve, really has very little to do with supply dynamics, because in a way supply controls demand, where if you have more supply you have more demand.
Hmm.
And again, I'll get into this mechanically in a moment. But I think that what you're seeing there is a direct result of growth and inflation expectations, and has nothing to do with the issuance at the long end of the curve, because the banks are always going to be the marginal buyer, or the banks are always going to be the marginal seller. And if I'm confusing people there, don't worry about it, guys. I've got some charts and we're going to get into it here in just a moment.
All right. So let's get to that chart real quick, but your top level thoughts on the markets, the health of the markets.
It's not different this time.
Great.
It's not different this time. And I had a tweet the other day, Adam, when the benchmark revision came out, like negative 911,000, and everyone was kind of losing their minds. And I said, there was some headline from CNBC that I retweeted or something. It said like, no one could have seen this coming. Everyone's shocked. And I said, yeah, everyone is shocked except for people that took 30 seconds and looked at the yield curve over the last year and a half.
Hmm.
like this is not rocket science. You just got to look at interest rates and look at what they're telling you. Look at what they're telling you and understand that what they're telling you about, what they're screaming, what they're shouting is all about nominal GDP. And not necessarily a recession, but a decline in nominal GDP growth and inflation.
All right. Well, look, let's get to your charts then, because I really want to see your explanation for all this.
Yeah. So the first component there was, I think you'll see a decline in the economy. And therefore, I think you're going to see interest rates go down, and nothing goes down in a straight line. There's always a lot of noise. But I think if we fast forward 6 months or a year, you will see lower interest rates pretty much across the curve. And then combined with that, I think that you'll see a return to disinflation, not deflation, not deflation, unless we
Hmm.
have some sort of GFC type of liquidity event, but disinflation, where, and I know the CPI is a terrible, terrible measurement of the inflation rate. And I would agree with pretty much all your viewers that it understates inflation. But
Right.
the reason I use the CPI is just to look at the trend. It's just
Yeah.
to look at the trend. That's
Yeah.
it.
And I'm going to guess you're going to think that the Federal Reserve is going to succeed more than they want to in hitting their 2% target.
Yeah, yeah, but I don't think it's the Fed succeeding, because I don't really think they have a big impact, and we're going to
Hmm.
go over why in a moment. The way I look at interest rates, Adam, is interest rates don't control the economy. They reflect what's happening in the economy.
Hmm.
And so if the Fed's dropping rates, I
And
don't
real
think,
quick, sorry, when you say interest rates, do you mean more bond yields?
yeah, yeah.
Yeah. Okay.
Yeah, and Fed funds. So if the Fed is dropping down to 3%, everyone might be cheering that. And I know a lot of the people in the housing market might be cheering that because, oh, yay, lower mortgage rates. But you got to be careful what you wish for, because you got to ask yourself why the Fed is dropping. And the reason they're
Right.
dropping is because the unemployment picture or the labor market is getting worse. And if the labor market's getting worse, then I don't know. Maybe that's not great for housing, because you got to take the good with the bad. And
Exactly.
and so you've got to ask yourself, what do those lower mortgage rates or lower Fed funds or lower tenure, what does that tell me about the health of the underlying economy? And if the economy is getting worse, and that's why you're seeing lower interest rates, then I don't know that lower interest rates in and of themselves are a good thing. That might be on net, that might be worse.
Right. No, totally agree. And have talked a bit about this on this channel before. Yeah, it's all about the reasons why.
Yeah, there you go. All right, so I'll go ahead and do a screen share. So the first thing, Adam, I wanted to go over is just how most people see the interplay between the Fed's balance sheet and the bank's balance sheet, or M2 money supply. And a lot of people use the term money printing. I think 99% of the people don't really know what they're talking about when they use that term. There is 1% there that they know exactly what they're referring to. But when people use this term, it's very loose. So I wanted to first and foremost kind of go over this so everyone, because this is our starting point. So we've got the government, they issue treasuries. Now, if this was more complete, the buyer could be a non-bank entity, it could be a bank, whatever. But then what the Fed's going to do if they're doing quantitative easing, or if they're trying to micromanage the interest rate, this would have been pre-QE when the Greenspan era, they would have bought this treasury, which creates more bank reserves. I'm sure most of your audience realize how that works. And then the idea there, what you read in the textbooks and what you hear in social media, mainstream media, is the amount of bank reserves that are available to the banks. This creates liquidity. This creates additional balance sheet capacity for the banking system in aggregate. And then they can go ahead and make loans. They can, they can provide credit, whatever. They can provide quote unquote liquidity. And then this often increases M2 money supply as a result of this additional lending. So
Right.
basically,
The more bank reserve, the more bank reserves the banks have, the more guys like me can come and borrow money from them to start a new business.
there you go. You got it. That's exactly what I was going to end with. So what we need to understand is this is totally and completely false. That this is not how the system works. And this idea leads to people making inaccurate conclusions and therefore setting up their portfolio in a way that's suboptimal. And so now let's go to the next slide here. So, Adam, this next chart is a chart of the bank reserves held at the Fed going all the way back to 1940. So, what we've done is we've taken I have this whole image of the Fed's balance sheet, and we've just removed currency in circulation. And so this goes from 1940 to call it 2007. And so what you can see is during this time, we go from, let's call it 10 billion, the B, and we fast forward to 2007, and we're at roughly 40. Okay. And then if you look at 1980, we're right around 40. You look at 2007, we're right around 40. Now, what's interesting, and I'm going to get into this in a moment, in the early 1950s, they changed it so they included vault cash in the equation for bank reserves. So prior to the 1950s, they did not include vault cash. This was just the electronic reserves, or back then I don't know if they were electronic, just whatever was written in the ledger or something like that. And then past the 1950s, that's when we get into the era where we actually had the vault cash that was included in these bank reserves. Now, I like to think about things excluding the vault cash because the bank reserves, like we said earlier, are all about interbank settlement. And banks aren't really using vault cash to settle these huge interbank transactions. So as an example, if you're Bank of America and I'm Wells Fargo, and I'm sending you on any given day, let's say $100 billion or whatever, or 500 million of deposit liabilities, because customers are transferring money from my bank to your bank, then I have to send you an offsetting asset. And so then I'm going to go ahead and send you those, the equivalent amount, 500 million, let's say, in bank reserves, and that's going to be the offsetting asset for that liability I sent you. That's one way to do it. So this is a chart exclusively of the bank reserves minus currency in circulation. But now what I want to do is look at this same chart, but look at it in terms of only electronic reserves. Only electronic reserves, because again, that's really the only thing that was available for the banking system in aggregate for those interbank settlements that would lead to the, let's just say, additional liquidity or additional M2 if the banks actually used bank reserves. And that's kind of the punchline. But let's get to the next slide. So this is a chart of, or a spreadsheet here of this is the H3 data, Adam, and this is from 2007. Now, the column I have highlighted is the bank reserves minus vault cash. So these are the electronic reserves that we were talking about earlier, and these are the reserves that the banks have available to go ahead and settle those transactions. So you can see that at our highest point in 2007, we were at 10 billion, 10, 11 billion.
Mm-hmm.
And so now what's really interesting is if you go all the way back to 1940 and you ask the question, well, all right, well, how many bank reserves, it just an apples to apples comparison, were in the system back then compared to 2007? And you get the exact same number. So, and we had some fluctuations here. I smoothed it out just to just to make
But
the
make the
point.
point, which is they haven't really changed much in the past century, close to.
Almost zero, almost zero. So now let's think about this. If banks are actually using these bank reserves or the Fed's balance sheet to settle, well, we know that it's been pretty much flat since 1940, going back, and again, this excludes QE. But the concept is what we're focused on here. So now let's go over and look at what has happened since then with global GDP and with global M2, understanding that a large percentage of those two numbers are going to be dollars. And then we can go ahead and think about that in terms of the bank reserves really not going up at all during this time frame. So now I'm just going to go to some of my tabs here, Adam. So you have to, it's amateur hour, I know, but
It's all good.
It's kind of how I roll on my channel. So this is a chart of nominal GDP, global nominal GDP. And we can see going back to 1960, we're at 1.3 trillion. And if you fast forward to 2007, 2008, we were right around $60 trillion. And let's keep in mind that the majority of the currency units, let's say, are going to be dollars because the dollar was the world reserve currency. And we can look at global M2, which will be the next chart here. And you can see that just from 1971, it was very, very low, and it just skyrockets all the way up to, let's just call it $60 trillion in 2007. So I don't know what global M2 was in 1940, but I know it wasn't 60 trillion.
Yeah.
It was a lot less than that. In fact, if we had in 1960, if it was 1.3 trillion, then I think it would be safe to assume that in 1940, it was less than 1 trillion. So we go from less than 1 trillion all the way up to 60 trillion, with the majority of that being dollars. And we saw a zero increase to the amount of bank reserves. So the question becomes, how are the banks doing this? If they have no other, let's say, settlement assets in the form of bank reserves, the conclusion you have to come to is that the banks were doing this off the Fed's balance sheet. They were not using Fed liabilities. They were settling these transactions amongst themselves on their own balance sheets. How were they doing that? Actually, quite simple. It was just interbank credit, just interbank credit. So let's go back to the example we used.
Probably on a net basis. So Wells Fargo and JP Morgan had a bunch of transactions between them for the day, but we're going to settle for the net and IOUX type of deal.
Yeah. And keep in mind, what I'm talking about right now is mostly outside of the United States. So outside of the purview of the Fed. We're talking about the Eurodollar market. So if we go back to that example we use of two banks settling, instead of Wells Fargo and B of A, let's just use some Cayman Island banks or something.
Yeah.
Right. So if I send you 500 million in liabilities, then we can just go ahead and settle up by you issuing me credit for the 500 million. And then that loan from you to me becomes the offsetting asset on your balance sheet. Or you have an account with me and that's my liability. So if I send you that $500 million liability, I just simply add $500 million to your, let's say, checking account that's on my balance sheet, and that's how we settle.
Mm-hmm.
And so what really determines the amount of loan growth, credit growth, liquidity, M2 money supply is not the Fed's balance sheet, but it's really risk. Because if there is very low perceived counterparty risk, then the banks are going to do this all day long because it makes sense for them and they're going to make money. Now, if there's an increase in counterparty risk, you're going to see this maybe not decline in total, but you're going to see this slow down to a significant degree, regardless of whether or not the Fed is doing QE or QT.
Mm-hmm.
Because now we fast forward to today, and you're like, wow, George, they got 3.5 trillion, let's say, in bank reserves on their balance sheet, the Fed. And okay, that's fine. But if we can safely assume that the banks don't have to settle on the Fed's balance sheet by looking at this data, it's obvious they don't. And obviously that there was some reason they weren't settling. And I think it was because it was costly and because it was cumbersome. And those two things exist today because you got to think about the number of pipes that are going to the Fed's balance sheet. Every single bank does not have a pipe going to the Fed's balance sheet. But many more banks have pipes going to primary dealers outside of the United States. So therefore, that interbank credit settlement in a correspondent banking relationship is actually something that's far more efficient. So the punchline there is if they didn't have to use bank reserves, if they chose not to use bank reserves before, then if the Fed increases the amount of bank reserves by, let's say, 200 billion or decreases the amount of bank reserves by 200 million, should that have a mechanical impact on the entire system? The answer is no. The answer is absolutely unequivocally no. Now, there's one more thing I'm going to show you, and then I'm going to tie this in to my view on interest rates. Because when you think about interest rates, a lot of people think about them in terms of growth and inflation expectations or nominal GDP, like we talked about earlier. But they also combine that with supply side dynamics or demand as far as foreigners dumping treasuries, or it's all about the debt. It's all about the deficits. And Adam, we know that the debt and the deficits are going to continue to explode into the future. That means more supply of treasuries at the same time when the Chinese and everyone else and their grandmother is dumping treasuries. And therefore, if we have nominal GDP in the United States at 4%, we should still expect to see long-term interest rates go up to 7, 8, 9, a total loss of control at the long end of the curve, which would prompt the Fed to come in and start doing yield curve control, and the release valve is going to be the dollar. That's the argument that you hear over and over and over and over and over again.
I've heard it a lot. Yep.
Yeah. So that's the supply argument is what I like to call it. But let's do one more thing here, and then we're going to look at the relationship between nominal GDP and interest rates. And then we're going to circle back and then try to answer mechanically why these correlations exist. Because that's, I think, the component that so many experts, and I wouldn't call myself an expert, but I think so many experts actually leave out. And I think it would help really connect the dots for most of your viewers. Okay, so the next thing. Now, Adam, we're back at the PowerPoint here. I'll just do this quickly. And prior to quantitative easing, if you read a textbook on how Alan Greenspan manages the Fed funds rate, what it would tell you is that because these banks need these bank reserves, then if they want the interbank rate to go down, then they would add bank reserves. And then if they wanted the interbank rate, or the Fed funds rate, we'll say, to go up, then they would simply subtract bank reserves. So it makes sense, right? The more bank reserves in the system, then you have more supply, then the price is going to go down, those yields are going to go down. That's what I've got reflected here in this
You're
lower
willing to lend more
balance sheet.
cheaply. Yep.
Yeah. And then, fewer bank reserves equals a higher interest rate. This is what you hear in the textbooks, right? So let's go ahead and look at this through the lens of what actually happened in history. Okay, so Adam, now let's quickly go back to this chart of the amount of bank reserves in the system, and we'll even include vault cash. But we can see from 1980 to 2007, we did not have an increase. We kind of went up, we went back down, but on net, we had no increase in the amount of bank reserves. So this would imply that the Fed funds rate was the exact same. And that would imply that M2 money supply didn't go up. Because think about it, if banks have this constant demand for bank reserves as the settlement asset, as M2 money supply goes up, then even to keep the interest rate the same, you would need more bank reserves. And then if you want the interest rate to actually go down, then you would really need a lot more bank reserves, but we saw zero. So now let's go over what actually happened. And we look at the Fed funds rate, which you can see goes straight from, let's just call it, what are we here, 18% roughly, or 19%. And as we all know, it went from 19% down to where it is today at roughly, well, here it was 5.26% in 2007. So we had a decrease in the Fed funds rate by 14%. 14%. Now, I'd like to point out that we had an increase in M2 money supply that went from, in 1980, roughly 1.5 trillion. Now, this is the domestic economy, by the way. And this goes straight up to almost 7.5 trillion during the exact same time frame. So again, you tell me, how on earth were banks using bank reserves, and how on earth was the Fed able to take the interest rate from 19% all the way down to 5%, while the supposed demand for those bank reserves should have gone parabolic, and they did absolutely nothing to their balance sheet? In other words, they didn't increase the amount of bank reserves at all. So if you take those two things, I don't know how you come to the conclusion that, at least prior to the QE, that the banks were actually using these reserves. So that's kind of the punchline here. So now let's move on to the nominal GDP and what we were talking about earlier with interest rates. And the main takeaway there from what we just discussed is the banks, in order to expand their balance sheet, the banks don't need bank reserves. They can do that during QT. It's all about the risk. It's all about the risk and reward. And if the risk reward makes sense, they're going to expand their balance sheet. It doesn't matter what the Fed is doing with their bank reserves. Okay.
Yeah. So just to underscore, so for banks to lend the way that they want to do, they are essentially independent of the Fed.
Not only to lend, but also to settle those interbank transactions.
Yeah.
Because they can lend, and that just creates a deposit liability, and then it creates a loan on their balance sheet. That's the offsetting asset. But most of the pushback that you'll get is people saying, okay, well, I understand that, but then when they go to settle with another bank, now all of a sudden they're going to need bank reserves to go ahead and send that deposit liability and settle up with bank B or C.
Got it. Okay. So again, but the key point here is just they don't need the Fed for that. And so to a certain extent, it sort of makes the case that a lot of Fed policy might not really be all that relevant here.
At least
correct?
mechanically.
Mechanically.
Psychologically, it absolutely is, but mechanically, it's not. And the main takeaway there that I would like to have your viewers really think about is the fact that this shows us that banks' balance sheets are, I wouldn't say infinite, but the balance sheet capacity for the banking system, especially outside of the United States and the Eurodollar system, is not constrained by what the Fed is doing.
It's not constrained by the Fed. Yeah, I get that's the key punchline I was coming to. That plus your point about risk, which I'm sure we'll talk about in a bit.
Yeah. So now let's go ahead and look at this kind of debate where is the 10-year Treasury yield, we'll use that as a proxy for the long end of the curve, is this about growth and inflation expectations, or another way to look at that is nominal GDP, or is this about the amount of supply that's coming online? So, Scott Bessent is going to dump 5 trillion of 10-year treasuries onto the market. That's going to make the interest rate skyrocket regardless of what nominal GDP is, because there's just not enough buyers. Another way to say that is there's not enough balance sheet capacity or not enough willing buyers. But let's put that to the test. So we have nominal GDP is this kind of light blue line, and the dark blue line is the 10-year treasury yield. And you can see that the 10-year treasury yield, and this goes back to 1962. So
Mhm.
even when rates were going up, even when rates were going down, you can see that the 10-year treasury yield curve, it's basically just a smoothed out nominal GDP. That's all it is. Now let's think about 1980 to today, or to 2020 or something like that, when you had the U.S. 10-year Treasury going down. What was happening to the U.S. debt? The amount of debt, the supply of treasuries. Now we can go to, let's see, the next chart I have, and we're going to look at this a few different ways, Adam. We're
Going
going to look,
ballistic.
yeah, first and foremost, we're going to look at this through the framework of the debt to GDP. So debt to GDP in 1980 was roughly 30%. Today, it's right around, call it 120%. Okay, so on that metric, debt has exploded. But that's not the only metric. We look at the actual deficits as a percentage of GDP, and we go back to 1980, and they're right around 2.4%, which I'm sure back then they were screaming and yelling about, which they should have, but for different reasons. And now we look at it, and we're not even in a wartime economy. We're not even in a recession, or at least the NBER isn't admitting to it. But yet the deficit to GDP is at 6.2%.
Yep.
And it's just getting worse and worse and worse. So on that metric, it's gotten way, way worse. Now let's look at the overall debt. And what I did here is I just have a chart of the federal debt going back to 1980. And then I've got a chart of the 10-year treasury yield. So you show me the correlation between the two, Adam.
Yeah.
Obviously,
I
an
mean,
inverse
it looks
correlation.
negative at this point.
That's right. There's an inverse correlation, at least during this time frame. And again, if we go back to that chart of nominal GDP and the 10-year treasury yield, you can see, I'm just guessing, probably an 85% correlation.
Yeah.
So there is no debate that in the past, that doesn't necessarily mean it's going to hold true in the future, but at least in the past, the 10-year treasury has moved almost entirely on growth and inflation expectations and nominal GDP, if you want to look at it that way. And it has, and the impact of the additional supply of treasuries that went from, let's just call it $1 trillion in 1980 to 36 trillion today, there was literally zero impact on yields, if not a negative correlation, maybe even a negative impact on yields. So now the question becomes, okay, well, why does this happen mechanically? Because that's key. Because you can't just say that, oh, it's worked this way in the past, and therefore it's just going to work this way indefinitely into the future. And when I make this argument, a lot of people think that's my claim, and it's absolutely not. So now let's think about this in terms of mechanically, Adam, what's happening here behind the scenes. This is just a very simple, oversimplified bank balance sheet here. We've got assets on the left, liabilities on the right. So let me start by asking you a question. I'll ask your viewers as well. And this pretty much explains almost entirely the mechanics behind why the 10-year treasury really is all about growth and inflation expectations and not about supply. And you remember at the beginning of the conversation, I was talking about how what's really weird about the treasury market is the supply, to a certain degree, actually impacts demand. So the higher the supply, the higher the demand is. And
Okay,
I'll explain why in a moment here. So what the banks are doing is they're just pocketing a spread between their liabilities and their assets. That's it. That's it. And this is a lot different than you and I, because we're not pocketing a spread between our liabilities and our assets. What we're doing is taking our hard-earned cash and going out there and potentially buying a 10-year treasury at, let's say, 4%. And we have to hope and pray that inflation doesn't exceed that 4%, or else we're losing purchasing power.
right.
But that's not how the banks work. That's not how the banks work. So let me ask you a question, Adam. If I, over the next year, let's say, if I gave you money monthly, and over the course of the next year, I gave you, let's say, $100 million, would you take that?
Yes, absolutely. You probably never hear from me again.
Okay, cool. All right. Now, but let me throw you a curveball here. Let me throw you a curveball. So you would take the $100 million, but what if I told you that the inflation rate in the United States was going to go up to 6%? Would you still take it?
Is this a loan I got to pay you back?
No. I'm just giving you money.
Well, yeah,
Okay. Let
better
me
than
throw you
nothing.
another let me throw you another curveball. What if I told you that during this time frame when I'm giving you $100 million over the next year, that the debt in the United States, in other words, supply of treasuries, is going to go from 36 trillion to 50 trillion? Would you still take the 100 million?
I mean, I would think so, yes.
The answer is yes, because it's free money. It's it's
Right.
it's it's free money. And so what people have to understand
I keep
is
looking for the catch here, but yeah, it's just free money.
no, but this is what the banks are doing because they're not using their money, they're using your money, or they're using money in the form of dollar credit that they themselves create.
Yeah.
So if they're paying, let's go to this bottom one where we see deposit liabilities. So I actually did a video the other day, Adam, where I looked at the interest rate that banks in the Cayman Islands are or were paying their depositors for dollar deposits. And it was right around 1.5%. 1.5%.
Hmm.
So they're getting money that they have to pay 1.5% for. But at the time, they could go out and buy a 10-year treasury, let's just say for 4.5%, or they could buy a 2-year treasury for, let's just say 4%. And so they're going to pocket the spread between the 1.5 and the 4. They're going to
Yes.
do that all
All
day
day
long,
long. Yeah.
all day long. And if there's nothing constraining their balance sheet, then the more Scott Bessent issues, the more they're going to be like, great, more free money, more free money. Now, what would incentivize them not to buy, or what would incentivize them to actually sell those treasuries? Well, it's if they look out into the global economy and they see a lot less risk and they see the global economy growing. And now it's a completely different equation because they're going to increase the size of their balance sheet by taking on dollar assets, whether that's in the form of a treasury or in the form of a loan. And it's got to match up with dollars because they're not going to take the FX risk. And they're also going to try to match up maturity. We call it duration risk. And what's interesting about most of the deposits outside of the United States in the Eurodollar system is they're actually time deposits. They're not demand deposits. So it's much, much easier for banks to go ahead and match up that
The
duration risk.
duration. Yeah.
That's right. So now let's say this bank looks out at the global economy, like, oh, wow, everything's looking great. Everything's looking rosy. Now it's a different decision because I could sit there and get the 4% or whatever it was from a 2-year treasury. Or what I can do is take that balance sheet capacity, lend into the real economy, and make 6%.
Right.
Well, if there's a lot less risk, the risk reward favors lending into the real economy. Now I'm going to make that decision. I'm not going to buy those treasuries, and the interest rate is likely going to go up. What I'm saying here is the banks in the Eurodollar system are the marginal buyer. They are the marginal seller. So if you have, let's just say, nominal GDP in the United States is using that as a proxy, and we're using that as a proxy for overall risk. Let's just say that's trending right around 4%, or that's hovering around 4%. Okay, well, if interest rates at the long end of the curve go up to 10% because Scott Bessent issues all these treasuries, now all of a sudden, instead of the 1.5% or the 2% spread or whatever they 2.5% spread they had before, now all of a sudden, Adam, they've got an 8.5% spread. but the risk for lending is still very, very high
Hmm.
because the nominal growth, let's say that proxy for risk is still right around 4%. So what are they going to do? They're going to buy. I mean, if they're buying when they're pocketing a 2.5% spread, what are they going to do when it's an 8.5% spread? They're going to buy the demand is going to skyrocket. And over time, what's going to happen, and it doesn't happen overnight, but over time, what's going to happen is that interest rate is going to go from whatever it was on the 10-year, bam, 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 all the way down to where it's roughly around what growth and inflation expectations are. And it's the exact same side with, or it's the exact same thing on the opposite. You know, a lot of people come out with stable coins argument. Well, there's going to be demand for treasuries with stable coins. Okay, well, let's just assume again that our bogey is 4% and the interest rate on the 10-year goes down to 2%, let's say, because of all of this demand from these new stable coins that are being issued. Okay, well, now the bank looks at that. It's like the risk reward doesn't make sense. There's no way I'm going to buy a 10-year treasury if nominal GDP is, or I think it's going to be at 4 and the 10-year is trading at 2%. No way. I'm not going to buy that treasury. In fact, I'm probably going to sell treasuries on my balance sheet. And then what's going to happen to the interest rate? It's going to go back up to where it is roughly, roughly with that 80% correlation.
Correlation to nominal GDP. Yeah.
Yeah. So these are the mechanics behind what's happening. So is this going to continue into the future? The answer is it depends. As long as the monetary system is set up like this is our future. Unfortunately, and I hate to say that, Adam, because the price that we have to pay for profligate government spending is not in the bond market. I wish it was, because that would put a constraint on the government spending.
It's on the purchasing power of the currency. Is that where you're going?
No, it's on the effects of into the real economy, because that government spending, what it represents is economic distortions because of the misallocation of resources, because of malinvestment. So when you have the government with basically a free credit card with no limit, they're going to spend. And I don't care if it's Trump, I don't care if it's Obama, I don't care if it's Kamala, I don't care if it's Biden. The amount they're going to spend, just like our good friend Lynn Alden says, is going to go straight up. Nothing stops this train. But the price that we have to pay for that isn't in the bond market. Unfortunately, it's in the real economy through the economic distortions that are created by that government spending to begin with.
Okay, so help me understand that. So I can follow you to, okay, a lot more government spending, a lot of malinvestment. Somebody might say, but hey, if they can just spend forever and it doesn't send bond yields to the moon, well, George, why isn't that a bad thing? Why is that a bad thing? So what would you put on the list besides things like growing wealth inequality?
The standard of living for society at large. It's going to deteriorate.
Okay.
And I mean, there's a great example, Japan, Adam, perfect example, because you look at their debt to GDP, you look at what they've done, and it's just government debt. And who's a gentleman? I think he's great, but this is where I first started to go over this concept and think it through in my own mind. Great friends with Bill Fleckenstein.
Yeah, Bill Fleckenstein, who's great friends with Mike Green.
Yeah, Bill Fleckenstein. I actually heard him on a podcast with Grant Williams. This is probably 5 years ago. And he came up with this thought experiment that I found fascinating, where he said, what if, because at the time, I think the BOJ owned 60% of the outstanding sovereign debt, JGBs. And he said, what if they just did a debt jubilee? Like, it's only 2 balance sheets. Like, would anyone even know? And I got to thinking about that. I'm like, no, if they didn't announce it, how would anyone even know? Yeah. And what impact would that have on anything? The answer is it most likely wouldn't. So then does that mean there's a free lunch? And does what you're saying there? And the answer is no, absolutely not. Because the price was already paid by the Japanese people. Their standard of living lowered, or at least was a lot lower than it otherwise would have been, because of the government spending that led to the JGBs in the first place being completely out of control and creating that malinvestment and the misallocation of resources, which creates really stagnation, to say the least. It creates economic stagnation, which again, that lowers the standard of living disproportionately, by the way, to the poor and middle class.
Okay, so I totally get all that. So I had jumped to what pays the price is the purchasing power of the currency, and you went more towards the deformation of the economic system. I'm still sort of seeing them as tied there, right? So when you
I don't know that it's it could be, but I don't know that it is, because what that implies is that the Fed is going to have to buy the long end of the curve And that's going to create more M2 money supply and more currency units chasing goods and services. And if it's not really about the supply of treasuries, I don't know that they would necessarily have to do yield curve control. I don't know that they actually would need to expand the size of their balance sheet to keep interest rates at the long of the curve right around nominal GDP. And so I don't know. Now, this is not to say that I don't think prices are going to be higher in the United States in 5 years. I, I absolutely do. And I
Hmm.
think that that this decade, we're going to look back on this, the 2020s, and it's going to be similar to the 1940s in the sense that it is on net an inflationary decade. Absolutely. But I don't know that that will, at least mechanically, it wouldn't have to come from the Federal Reserve doing yield curve control. I think it probably would come more so with what we saw during COVID. And it isn't necessarily about just the massive expansion of the money supply, but it's more so about the destruction of the amount of goods and services that we have available to us, where it's a supply shock. And I know a lot of people are probably saying, but George, in from 2020 to 2022, M2 went up by 25%. That's true, but I don't know how much of that contributed to the 9% CPI that we saw. Definitely a component, but I would say a bigger component of that inflation was the supply shock.
The supply shock, you think? Okay. All right. Well, look, I don't want to interrupt you if you still have more slides to get through, but I have some kind of big, you know, okay, so what does all this mean?
Yeah, what
Type
this
of questions
means
for you.
is I think that interest rates are going to go lower because I think we are going to have a slowdown in the economy because of the labor market. And
Yeah,
I also think that we are, because of that slowdown, I think that's going to lead to disinflation. And if we get disinflation, that's going to be lower growth and inflation expectations. And that's why I say, from a mechanical standpoint, why I say that my base case looking out 6 months or a year is that we have lower interest rates across the curve.
got it. Okay. And look, so first off, fascinating framework and data walkthrough here, George. I learned a lot, and you know, one man's opinion. This confirms sort of my default assumptions of where I think things are headed here. I agree with you. I think disinflation, slowing economy, more likely. Do we go into recession or not? Too early to tell here. I think you say the same thing, but wouldn't surprise you, right?
I
So,
don't know if it's recession because then we're dependent on the NBER announcing a recession. But what I would say is I expect lower nominal GDP growth.
right. And I'm guessing you would say, and it will feel less fun to people a year from now than it does
Yeah.
today.
Yeah.
Um,
Unfortunately. Yeah.
Now, a lot of people are going to say, well, let me put this, two questions for you. There's a lot of people who would say, all right, George, but what about the reaction function of the central planners? And if it gets painful enough, they're going to send QE to the moon and they're going to do all this other stuff again. So A, do you expect something like that to then potentially, boost us out of recession? And separate from that, which also might be concurrent, is the new administration is pursuing a lot of business stimulative policies
Hmm.
that will take quarters to be felt. But if indeed, I mean, we've been able to lock in the lower tax and make the tax cuts permanent. We've added some additional tax relief on top of that. We're deregulating, we're striking these new trade deals and whatever. So do you expect as well to be there to be as well some boost to the economy at some point later 2026, 2027 from those policies as well, if they're able to be affected as intended?
Yeah. So basically, we don't know what the end result is, but it would be a tailwind to economic growth.
Hmm. So, and
Yeah.
I'm
I
not
know what
trying
you're
to
saying.
I'm not trying to
Yeah. I know what you're saying.
simplify it, but you sort of see like a dip in the
Yeah.
economy
Yeah.
over the next 12 months, but then a potential rebound either from those policies providing tailwinds
Yeah.
and or some sort of aggressive central planner reaction function.
Yeah. I think to take it in sequence, if we get a dip in the economy, and it depends on how dramatic it is, and it depends on how dramatic, if we do have a decline in the stock market, it
Hmm.
depends on how quick, it depends if we have like a liquidity event, like a GFC type thing, or if it's a garden variety recession and balance sheet recession like .com. If
Hmm.
it's balance
Let's
sheet,
start with garden variety just because nobody can really predict a GFC type of thing.
Yeah, I think you just have a kind of a slow grind lower. I don't know. I mean, the Fed would probably come in with some QE. They would definitely drop rates, obviously.
Yeah,
That's kind of what I'm expecting, but I don't know that that would really make a big difference because, again, those interest rates are going to be a reflection of the economy. They're not going
of
to
the
control the
GDP.
economy. I think what would get us out of any type of malaise or what would make it a lot worse than it otherwise would have been would be fiscal. It would absolutely be fiscal. And if you look at what happened in March of 2020, Adam, you'll probably remember when the Fed came out with their emergency meeting on that Sunday. They were supposed to have the meeting on Wednesday. They dropped interest rates all the way down to zero. They announced up to I think $1 trillion a day in repo. They basically announced QE infinity, and the market the next day went down by I think 1,500 points.
Hmm.
It just kept going down. The market didn't care. It's like the Fed put was expired, done. And so what turned the market around was actually the announcement of the CARES Act. So it was fiscal. And so that's really, really what did it. So I think if that is going to be an outcome, then I would focus more on the fiscal and a lot less on the monetary
On the
policy,
monetary.
especially considering, what we were talking about mechanically before, where it just doesn't have an impact because the banks don't need those reserves. But it does have a psychological impact. And I want to be very clear, just because I'm saying the Fed's balance sheet really doesn't matter to liquidity in normal times, that's not to say that the Fed's balance sheet doesn't matter when they're bailing out the banks. That's a
Okay.
whole other different can of worms. And obviously, they can bail out, and that makes a difference. But I don't know that that would be inflationary. I think that would be anti-deflationary. And those two things are different. So it all
One is
depends on the
stabilizing, one is, yeah. Okay.
yeah, it all depends on the fiscal component there, and then it also depends on the supply of goods and services. If we break down global supply chains as a result of the fiscal response, then that could lead to the supply shock or a type of supply shock like we saw during COVID that could see a huge, huge price increase overall. And again, very similar to what we saw in the 1940s when they had price controls. They lifted the price controls, and then boom, you just saw. I think the CPI went to 19%, and then 2 years later it was -2,
Hmm.
and that wasn't really a result of M2 money supply growth. It was more so a supply of the government distortions we were talking about earlier, and I don't know how to predict that. Now, going to the next part of your question about is there going to be some economic tailwinds once we come out the other side? I think that depends on regulation. Because if you're just doing all of these pro growth measures, but you're not reducing regulations or you're increasing the amount of regulations, then I don't think it moves the needle. Because look, if you take my tax rate from 30% down to 25%, but you increase the regulatory burden, I'm not going to grow my business. There's no way. And a lot of that also depends on the consistency of the policies themselves. And I don't know how it's going to be in the future, but we do know that since January, the policies have been, let's say, haphazard. to say the to say the least. So if you're a business owner and you don't know what your tax rate or you don't know what the tariffs are going to be like tomorrow, you don't know any of this stuff, you don't have a huge incentive to grow your business. And if you're thinking about, let's say, spending $2 billion on building a factory in the United States based on where the tariffs are today, I don't know that you're going to pull that trigger when you don't know where they're going to be tomorrow, or that factory is going to take you 5 years to build, and by that time Trump's out of office. So to me, it's all about the regulations, and if you reduce regulations and you do those pro growth strategies you're talking about, assuming they are pro growth, then yeah, I could see that being a significant tailwind for the U.S. economy that could be hugely beneficial to the poor and middle class. I know you love kind of analogies, Adam, so I'll give you one that I always use
I
on my
do.
channel. And that one thing I don't like about tariffs is that we're trying to combat central planning with just more central planning. With like, okay, we can't beat the Chinese because they have all this awesome central planning. So we just need central planning of our own that's just better. And that's the only way we're going to beat them. And for me, I always looked at that like, let's say you are going up against Shaquille O'Neal in a game of one-on-one basketball. And you're like, okay, well, who can we get, out of the history of the NBA, let's say, well, who's the guy that we can get to go up against Shaquille O'Neal? We really need to beat him in this game of one-on-one. Well, what we're doing is we're saying, okay, well, we have to start by getting a guy that's at least 7'2". And the next step, we got to get a guy that's, as the 22 size shoe. And then we basically have to get a clone or maybe a little bit better Shaquille O'Neal, where I'm saying we don't need Shaquille O'Neal. We've got the greatest basketball player of all time. His name's Michael Jordan. Now, is he 7'2"? No, he's not. Is he as strong as Shaquille O'Neal? No, he's not. But you know what? He's a hell of a lot faster and he's a lot better. So instead of more central planning to try to compete with the central planners of China, I think we should just have more free market capitalism. In other words, we should just take Michael Jordan, who literally has a ball and chain around his ankles right now in the form of regulation, and just take off that ball and chain, and then just say, go get him, Michael. And I can almost assure you that Michael Jordan is going to beat Shaquille O'Neal, even though he's not 7'2". Just like I can almost assure you that if we reduced regulations in the United States and created all these incentives, then our economy with free market capitalism would be able to beat the communism, for heaven's sakes, the central planning of the Chinese.
Yeah, I don't disagree with that sentiment. And if you haven't interviewed him, you should talk to Art Laffer. He'd probably applaud everything you just said there. Full disclosure to Art, he says he doesn't necessarily mind tariffs as a threat, but actually the implementation of them he doesn't like. He's a big free market, free trade guy, just like you. But anyways, I totally get what you're saying. Is it depends upon, how the chips actually fall with regulation and
Yeah.
everything they're trying to do. And again, I don't know if it's these things are going to work out. I'm just saying. I know that is the administration's intent, and if they are successful in that, could it have a tailwind? I think your answer is yes, provided all the caveats that you just put in there.
Yep. Yep.
And let's actually hope so, because your logic is pretty compelling that things are probably not going to be so fun for the next 12 months. And when we're there a year from now, we're going to be looking for something to pull us out of that.
Yeah, which unfortunately, even in the United States now, our default is central planning
Yeah. Well,
and more
let me ask you
government
this.
spending. That's
Yeah.
like the cure for everything.
For,
And at the end
for,
of the day, that's the problem.
well, so here's a worry that I had. I'm sure you had the same one, starting a couple of years ago, which was when we let the genie out of the bottle and we said, you know what, we're going to do fiscal direct to household fiscal
Mm,
stimulus, right? Um,
yeah.
the worry is that that's now in the tool. That tool is now in the toolbox.
Yep.
And that the next time there's a downturn, the policymakers are going to say, well, yeah, let's do it. We did it last time. It actually was way more stimulative than monetary stimulus. So let's do it, right? And of course, the populace is going to say, hey, you did it last time. Why are you not doing it this time? In fact, give me more this time, right? And I mean, sadly, we're going to, too few people, I think, tie the huge spike we had in inflation to the direct to household fiscal stimulus. It's much more,
Hmm.
in my opinion, much more inflationary than monetary stimulus.
Absolutely. I agree.
And so that's going to be, to the extent it was in people's brains, they're going to push it out when the pain comes, and they're just going to say, look, I don't care. I got bills to pay this month. Give me a check, right? Now, granted, we have an administration that might be more reluctant to do that than the previous administration, but I think that's open for debate. How worried are you about the precedent that's been set there?
Very worried, especially with AI. I mean, you look at what AI is doing right now, and it's as bad as it's ever going to be. It's the worst it's ever going to be right now. It's only going to get better. And I think a big reason why we're
You
seeing
mean the
the
quality of the AI performance is
correct,
the worst it's ever
correct,
going to be right now? Yes,
correct.
agree.
And I think a big reason why we're seeing such a high unemployment rate with college graduates, especially the white collar jobs, is because of AI.
Hmm.
And so I think, and now that's not to say I'm bearish on it or I don't think we should have it. I think longer term it's going to create a lot more jobs on net, But
I hope
from
you're right.
it,
I'm not,
it-
I haven't been sold on that, just FYI, but I'm open-minded to it.
yeah, well, I think we can both agree that getting from A to B is going to be rough. It's going to be very, very rough because of the speed at which things are changing. So what you're talking about there, as far as inflation, is all about the velocity of money. So
Hmm.
even if we don't have an increase in the money supply, if the government is taking savings and turning it into checking, which is how I think about it in my mind,
Okay, yeah.
and then you're gonna, it doesn't matter if the number of currency units don't increase, especially if the supply is decreasing, velocity increases, you're gonna have a big, big spike in inflation. And you're talking about UBI, basically. And I absolutely think that's where we're headed. Now, will we be there in 6 months if we have a severe recession? Probably start with the stimmies, and then I think it's just going to be more and more permanent. And especially if we have a large spike in the unemployment rate due to AI taking all the jobs, or however you want to say it, and that could lead to the 1940s, that we're talking about. Now, in that scenario, would I still be bullish on bonds? Absolutely not. Absolutely not. But I would change my prediction, let's say, from lower yields to much, much higher yields, especially at the long end of the curve. But keep in mind, I wouldn't change my opinion based on supply dynamics. I would not change my opinion based on the fact that the deficits are blowing out or the debt is increasing. I would change my opinion based on growth and inflation expectations.
Okay. All right. Um, George, super fascinating, and I've got like a zillion questions. I'd still love to drill down with you further on this, but let me get to the super rubber meets the road. For viewers, just to make this super practical. Okay, so George Gammon expects that the economy is going to slow further from here. The unemployment rate is likely going to rise. Are we going to go into recession within the next 12 months? Don't know, but wouldn't surprise you. Basically, life's going to get harder for the majority of people over the next 12 months. The stock market is currently in a bubble while that's happening.
Yeah.
So at some point, presumably along this journey here, Wall Street's going to have to say, look, we've been a little bit too aggressive in our earnings expectations given the slowing economy. We're going to have to reprice things downwards from here. And that's kind of a garden variety repricing. Now, there could
Yeah.
be some other things that might happen, if employment rate gets high enough that the passive bid starts getting, I mean, there's a huge number of things that could happen, but let's
Yep.
not worry about that stuff
Yep.
just yet. How are you thinking about investing as we enter this next 6 to 12 months that you're looking at?
Great question. Because when I talk about the stock market being in a bubble, as an example, everyone says, well, George, if you weren't invested in the stock market this year, you would have missed out on all those gains.
Mhm.
I hear that. I hear that nonstop, as if it's a binary decision,
Right.
right? As if the only decision you have is to be fully invested in an S&P index fund or have 100% cash. Those
Yeah.
are your only two options, Adam. But what's great is you look at, oh, I don't know, gold. I mean, what's gold up this year? You probably know better than I would, but it's up
I
a
do.
hell
It's
of a
up.
lot more than the
It's
stock market.
close to 40%.
40%. Okay. I think the stock market's up maybe 10, 12%, something like
Yeah.
that, year to date. Let's look at GDX, or excuse me, GDXJ, which is something that I have, just full disclosure, I have in my own portfolio. And that's up
Good for you.
90,
It's
100.
no more than that. Yeah, GDX is up over 100. I'm guessing GDXJ is up by more.
Yeah. Let's talk about another thing I have in my portfolio, URA, which is a proxy for uranium. It's more the uranium miners in there.
Yep.
That is up. I don't. I would say I should pull up a chart. But editor, help me out here. Throw up a chart, and I'm guessing it's up probably over 50% this year. URA, and way, way, way more than the stock market. And I could go on and on and on about these things. And it's not just, Adam, that they're up a lot more than the S&P 500. It's that the downside risk to begin with was a lot
Absolutely.
lower than it is right now, when the price to sales for the S&P 500 is trading at all-time highs. when the Buffett indicator is at what, plus 200%, when Buffett
Plus 200%.
himself has got 330 or 50 million or billion, excuse me, in cash, and he has a bigger cash position as a percentage of the portfolio than he's ever had. When you look at the CAPE ratio, Adam, it's at 39, for heaven's sakes, 39. So again, the point there is it's not just that you had a better return, but you had a lot more or a lot less, excuse me, downside risk to begin with. And I think that's the main takeaway for the retail investor as far as strategy is you always have to make asymmetric bets, asymmetric, where the upside is a lot greater than the downside. And if you do that, that's the first key to success. But you cannot be a successful investor unless you have that asymmetry. And I don't know how you can argue that you have that asymmetry in the S&P 500 right now.
Yeah, I just saw a chart earlier today, and if what I say is wrong, I'll come back when I edit and pull it out. But I think it was the percent of S&P companies trading, S&P 500 companies trading above 10 times price to sales.
Mm,
And it was like over 30%. I mean, there's only been one other time in history where we're close to that. And these are two huge outliers. But I mean, isn't that
yeah,
amazing?
yeah, yeah.
And we remember the dot-com era with Scott McNealy's famous rant about when Sun was trading like 10 times price to sales. And he was like, investors in my company, you're all idiots. You're all paying way too much for it. Yeah.
yeah, and it's not that the stock market can't go up. I have no idea where it's going to go. I mean, maybe it doubles from here going into the end of the year. But the question isn't necessarily is it going to go up or down. It's what are the probabilities and what's
Right.
the risk reward? What's your upside downside? I always use the example of blackjack because it's a game that most everyone knows and most everyone has played. Well, let's say that you have a 19 and you have the option of hitting. Is anyone in their right mind going to hit on a 19? The answer is no, absolutely not, because the odds are against you. But that doesn't mean that if you do hit, you can't get 21. You can still get a two, Adam. But
Right.
just because you can get a two and you get 21, it doesn't necessarily mean that the odds were in your favor and that was a good decision.
That's a
And
great
the
analogy.
S&P 500 right now is basically hitting on a 19.
That you told me you mentioned that I love analogies, which I do. That is a great one, and I'm going to steal it from here if you don't
No
mind.
problem.
I'll give you attribution, but that's a great one. Okay, so asymmetric bets. So, a couple questions for you. So, where do you see asymmetric bets right now? I'll let you comment on gold because there's a lot of people that are saying, sure, it's up 40%, but this is the start of the whole repricing and it's going to go way higher from here. But I'm guessing that energy, maybe even particularly oil right now, maybe has your attention given how unloved that sector is in general. Plus, it's just still an essential commodity and it is cyclical, and presumably it'll have an upcycle at some point here.
Yeah, I'm definitely I like trends. I like the trend is your friend. I mean, I
Mhm.
really like I've had the wonderful opportunity to meet a lot of very, very, very successful investors and hedge fund managers in my life. And the best ones always are, whether they know it or not, are trend followers. And if you think about value investing, the guys and gals who really make money in value investing are the people that look for that deep value, but they always have to have a catalyst before they buy. They never
Okay.
ever buy something just because it's
Just
cheap.
because it's cheap, they want to see it starting to move.
That's right.
Yeah.
And what are they doing? They're just trend following,
Yeah.
basically. So I always like looking at the trend, and if the trend is in my favor, it might. Um, well, if the trend is in my favor, I'm going to be much more likely to buy that if it's already on my watch list than something that's on my watch list where there might not be a catalyst yet, or I
Sure.
don't see it in the charts. And so oil right now, I've got it on the watch list. I love it for sure. Same thing with silver. But due to my base case with an economic slowdown, I'm hesitant. I'm very
Yep, and that
hesitant.
makes total sense. Okay, get that. Yeah.
Yeah.
But it is on
So
your
I
watch list.
absolutely. So I would, and obviously uranium, but through the miners. Another thing, I like the long end of the curve. I've got a position in the 30-year treasury right now, just
That's
full
right.
disclosure. that I've had for a couple weeks that
Yep.
I did it through
And you're already
futures
up on, right?
way up. I mean, I'm up probably 50%. But I don't know. Again, this is not investment advice, and I'm not saying go out and do this because I could sell tomorrow, and
Yeah,
I might
I very
sell
much
tomorrow.
following you on this. It very much was this was a trade that you were making. Yeah.
That was absolutely a trade. Yeah, would I buy a 30-year treasury right now and hold on to it for the next 10 years? Absolutely, unequivocally, no. There's no chance, even though I'm bullish, let's just say, over the next 6 months or so.
Okay. I got one more question on investing to get to, but real quick, thoughts on gold and even you mentioned you're still excited about silver. But you know, both have done great. Silver
Yeah.
still has some catching up to do based on historical ratios. Miners have obviously done great. Um, so some may argue, you know, I've already had a lot of discussions this week about, hey, if you're sitting on big gains, maybe you want to lighten up a little bit and just rebalance and that type of stuff, which maybe you would agree with. But in terms of the trend and how much legs this has, what you're thinking?
It's got a lot further to go.
Yeah.
Trend is your friend. Look at the trend. Just pull up a chart. I'm just talking to your viewers. Pull up a chart of gold, and that year to date, that is a trend. That is a gorgeous trend. That is a phenomenal looking chart. Same thing. In fact, the GDXJ is probably even better. That's a sensational looking chart. Now you could have a pullback here. You know, we may be way overbought. We probably are. But I'm not a seller here. There's no way I'm a seller here. And I get this I have a subscription service called Rebel Capitalist Pro. And I get this with our members all the time. They're like, I'm made this much money on the miners. I'm this far up on gold. Should I sell? Should I sell? And I'm like, I can't tell you what to do, but I can tell you that I'm looking at the chart. The trend seems intact and I'm not selling. Now, when would you sell? You would sell if if your fundamental analysis changed.
Mhm.
It changed. And I think the fundamental analysis for owning gold has has not changed. And B, I think there's an even better argument for for owning gold and the gold miners. And I would say the same thing for uranium or however you want to play that. And over the short term, maybe the next 6 months, I would say that it's probably the same for the long end of the curve. But just take that all with a grain of salt, guys, because I'm an amateur just like all of you, and I'm just trying to figure this stuff out.
All right. Look, last question on investing, then we'll wrap it up. Um, so you expect yields to come down, both for the mechanical rationale that you walked us through, but also because the Fed is likely, at least on the short end, rates will come down because the Fed is likely to be cutting from here, right?
Yeah, but that
Um,
could, again, it depends on growth and inflation because the Fed cut 100 basis points at the end of 2024 and the 10-year treasury went up by 100
right.
basis points. So why was that? I think because the labor market was pretty solid back then. And remember in December, we had like a blowout headline number of like 330,000 jobs. And I think the market looks at that and says, oh my gosh, the Fed is cutting into a booming economy and a booming labor market. But now it's the complete opposite in the labor market. You have an obvious deterioration. And so I don't know that if we see big Fed cuts that we will see the long end go up, although we could, it's definitely not my base case.
Yeah.
And one thing I'd like to add, Adam, is because a lot of the pushback I get on this thesis is, well, even if the unemployment rate goes up, we could be in stagflation. We could be in stagflation, implying that we could have the unemployment rate go up. We could go into a recession while at the same time the CPI, just using it as a proxy, is accelerating to the upside. So it's
Right.
not just higher than the Fed target, but it's going from, let's say, 2.9 to
Right. It's
4 to 5
increasing.
to
Yeah.
6, boom, boom, like this, right? And I would strongly encourage your viewers to look at a chart of the inflation rate, the CPI in the 1970s, and compare that with the unemployment rate. And what you find is we'll just use the recession of 74, 75. And during that time, you had, the CPI going up, 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 up. But as soon as that unemployment rate, Adam, spiked straight up, it just,
It just went down.
the
Yeah.
inflation rate just, now we didn't go to deflation, but we had massive disinflation.
Disinflation. Yeah.
And
And that's
so
because we're a huge majority consumer
yeah,
spending driven economy, right?
that's a lot of it, and it's the exact same thing. So whenever you look at a recession, when we have that big unemployment spike, you always, always, always see disinflation, even in the 1970s. And the one pushback I get there is, well, George, but now we've had all this M2 money supply growth, from 2020 to 2025. And what's fascinating, Adam, is if you actually pull up a chart of M2 money supply from 1970 to 75, it went up by a higher percentage than it has
Really?
from 2020 to 2025.
Okay. So one thing we didn't talk about, and I don't want to get too sidetracked on it because I still have a key question I want to ask you before we wrap up. But we haven't really talked much about tariffs. But I think a lot of people will say, well, hey, one of the reasons why bond yields have been elevated on the long end of the curve is because everybody's worried about the inflationary aspects of tariffs. And we've been waiting to see the details on it. And we don't know the full story yet. But I think it's becoming increasingly clear that they are not as inflationary as the market initially feared
Mm,
coming out of Liberation Day. And I think for the Fed to change in its wording today, that uh, we now think the balance of risks is to a weaker labor market versus inflation remaining higher than we want. It seems to the Fed themselves are even beginning to say, okay, we're starting to get a little bit less worried about inflation.
yeah.
So, uh, uh, you know, I guess unless and until tariffs really prove themselves to be markedly inflationary here, that's another reason why rates may come down in the long, or might not go higher on the longer end.
Yeah, I think there's two components there. Number one, if you have a deteriorating labor market, then even if you do have prices of XYZ, or let's just say the price of oil, that's a good
Right.
example because oil is an input to almost everything. You just get to a point where you're robbing Peter to pay Paul.
Yeah.
So you're just, okay, you've got so much in your paycheck is not going up. And if the price of the stuff you need is going up, then you have to allocate a higher percentage of your paycheck to that and a lower percentage
So somewhere else.
to
Yeah.
somewhere else. And that's going to kind of have a balancing effect. And then also, if you look at the data, and you can start by looking at import prices, which do not include tariffs. This is very interesting. So if you look at import prices, you see that they have not gone down, which tells you that the foreigners are not paying the tariffs. They are not paying the tariffs because since the import prices do not include the tax, then in order for those foreigners to eat the tariff, so to speak, they would have to drop prices,
Prices. Yeah.
and they're not dropping prices. So are we seeing it come out in the CPI? Not really. Not really. A little bit in goods because we see disinflation in services still. But who's eating the tariffs are actually the US importers. They're the ones. So let's just say they had a 20% margin going into this. Now they've got a 10% margin. And they're just trying as hard as they can not to increase those prices and pass them on to the consumer because they know that the demand's not there.
Right.
And if they increase the price, demand is going to fall off a cliff. And on net balance, they're going to be worse off. So that's what's happening right now. And I don't know how we get to a point where those importers are able to pass on
Pass
the
on.
higher prices, even though they might try just due to necessity. But then I think it creates a lot less economic output because of that robbing Peter to pay Paul dynamic we talked about. And let's remember that if they're robbing Paul, then Paul is going to fire workers.
Well, that's what I was going to say. So even if they determine they can't pass on the tariffs to the end consumer, the longer this goes on and
Yep.
the profit margins get squeezed, they have to start firing people,
Yep.
and that is going to depress consumer spending,
Yep.
and make decrease demand, which would then bring yields down
Yeah.
anyway.
It's a feedback loop.
Yeah. Okay. So here's the question I was working up to here, which is if the Fed is indeed in a cutting era now, and assume for a moment here it ends up cutting, I don't know, let's say 150, 200 basis points by the time all is done. The T-bill and chill trade largely starts to go away.
Yeah.
What do those investors do?
It depends on what asset prices are. I mean, I have no way of knowing that. The best advice I guess, again, it's not advice, but I can tell you what I do. And I don't know if I've ever told you this story, but have you met my sister?
No,
I don't know if you've ever met her at a conference or something like
no,
that.
no, I've not had the pleasure.
Okay, I'm trying to twist her arm to go to New Orleans, so hopefully you have the opportunity to meet her.
That would be
She's
wonderful.
she's 10 years older than I am, and she is literally the best investor I've ever seen in my life, Adam. I would put her up against Stan Druckenmiller,
Wow.
and I'm not joking. I'm not joking. So what's interesting is my sister, she's
Why isn't she presenting at New Orleans then?
exactly. She should be. She should be. But what she used to do is she's always been very stingy with money. Or actually, I shouldn't say stingy. I should say prudent with
Yeah,
money.
frugal.
And yeah, she's made a lot of money in her life, and so has her husband. And she usually managed the finances. But what she used to do when both her and her husband were making a lot of money, and she had two daughters. They were in school at the time. Is she would never ever buy them clothes during the year. Never, not even one pair of Levi's. What she would do is she would just make a list on the refrigerator of
Hmm.
all the things they needed, and then Black Friday, she would wake up with the girls at, like, I'm not kidding, 3 o'clock in the morning, and she wouldn't even go to the mall. She'd go to the outlet mall just so she could get a better price.
Okay.
And then she would take her watch list and she would just buy everything that she wanted to buy or what that she needed that was on sale. She does the exact same thing with her portfolio, Adam. So what she'll do is she'll just sit there and make a list of all these things that she wants to buy. And she won't buy any of them unless they get down to a price that she likes, that she thinks is on sale. And then she'll go ahead and buy. So that's what I'm doing right now. That's what again, I can't give advice, but I would suggest your listeners consider a strategy like that, because we just don't know how this is going to play out. We don't know what the price of oil is going to be in 6 months. We don't know what the price of gold is going to be. We don't know the price of S&P. We don't know what real estate in Miami is going to be. So it just all depends on where you can get the good deals.
All right. You're reminding me of something I like to remind this audience from time to time. You probably heard about the science of hitting, Ted Williams, or he would analyze the batter's box, and he knew exactly where within the batter box what his batting average was,
Mm,
anywhere within there. And so what he would basically do is say, my job was just to wait for a pitch to get into my sweet
yeah,
spot in the batter's box, and that's when I would swing. And the challenge that he had is that he could strike out, right? So eventually he would
just
have to
waiting.
swing. He would sometimes have to swing at a non-perfect ball just because it was close enough. It would be a strike, right? So Warren Buffett talks a lot about that. Warren Buffett says, no, that's the right approach. But in investing, he's like, I don't have the strike limit. So
Yeah, you don't have to
I
swing.
can let 1,000 pitches go by. I only need to swing when it is right exactly in my sweet spot. And so you're reminding people of that in general, but also that the fact that we have a better than average, we could maybe agree on probability of some corrective event in the market there. So, just wait, and hopefully the market's going to serve you something that you really are interested, that's on your watch list, hopefully at the
Yeah,
price you want, and then you
yeah,
swing.
and especially if the macro environment is conducive to what is on your watch list. I always have that macro overlay, but it goes back to what our good friend Jim Rogers always says. He's been my favorite investor since I started to get into investing, and I remember I've read his interview in Market Wizards probably 1,000 times. Adam, I mean,
Mm.
I almost know it word for word. And remember in the interview, he said he was talking to Jack Schwager about how most retail investors, they just always feel like they have to do something. I've
Right.
always got to be doing something. And he says, no, you don't. He says, you don't have to do anything. He says, what you do is just sit in your chair and wait for a big pile of money to show up in the corner. And when you see the big pile of money, just go over and pick it up. And that's basically what we're saying.
Yeah.
Wait for the big pile of money. And the pile of money with the S&P is not there right now.
And it's so funny because human nature, we just always feel this pressure to do something, right?
Yeah.
And we get ourselves more often than not, I think, into trouble with doing way too much versus just waiting. And this is potentially somewhat apocryphal, but you hear the stories of the studies that like Fidelity did, where the people who had the best performances were the people who were dead or who forgot they had accounts and they just didn't touch them and they ended up doing just fine, right?
Yeah.
Yeah. All right. Well, look, George, this has been fantastic. Thank you so much. I'm sorry it has been so long since we've done this. I'll definitely commit to doing it more frequently in the future. I really appreciate you putting together all the sh slides and walking us through those important sort of system mechanics. I think it's really going to help me for sure know how to think about kind of just sort of systemically how things will work going forward. Most important question of the interview for folks that have really enjoyed this, maybe for a few, it's their first exposure to you. Where can they go to follow you and your work?
YouTube. They can just type in George Gammon, and you're going to get the George Gammon channel, which is exclusively whiteboard videos, where I do
Which are
my very
phenomenal, by the way.
thank you. I do my very best to explain this stuff. And then my other channel is the Rebel Capitalist channel, which are just talking head videos, kind of with my background here. And I usually do them live. So they're just live streams on me kind of riffing what's happening in the financial media during that day. So today I'm going to do a live stream on the Fed's interest rate decision and kind of, whether it was dovish and all that stuff. So it's either George Gammon, Rebel Capitalist channel, or I've got a channel like yours. I'm just trying to use you as an example. It's not as good as your channel, but it's called Rebel Capitalist Interviews, and those are the three main channels.
All right, great. So, George, when I edit this, I will put up the links to all three of those channels here on the screen so folks know where to go. Folks, the links will also be in the description below this video as well. I was smiling when you were talking about going to do your live stream because literally when I get off of here, I'm going to go do my live stream without reacting to the Fed info. So
All
it's
right.
fun to talk to somebody in the exact same trade here.
Yeah, yeah.
All right. Well, look, folks, if you have enjoyed this discussion with George, even half as much as I have, please let him know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. George has given us an awful lot to think about in terms of both the direction of the economy, what can happen in markets, and how to think about potentially how to invest for the environment that's coming, especially if it unfolds the way that George thinks it might. If you think you might want some help from a professional financial advisor in trying to look at your particular situation and figure out the best course of action might be for you, I highly recommend you should do that. Get that advice from a good financial advisor. Importantly, one who takes into account all the macro issues that George has talked about with us here. To be honest, when you put that last requirement on, the universe of good financial advisors who understand and take that info into account shrinks pretty quickly.
Yep.
But if you've got a good one who's already doing a good job of both putting a strategy together for you and then executing on it for you, great. Don't mess with success. But if you don't have one, or you'd like a second opinion from one who does meet those requirements, then consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses. To do that, just fill out the very short form at thoughtfulmoney.com. These consultations are totally free. There's no commitment to work with the firms. It's just a free service they offer to try to help as many people as possible, position as prudently as possible for what may be coming ahead. Lastly, just want to remind everybody that the Thoughtful Money Fall Online Conference is coming up now it's just a month away. Saturday, October 18th. Don't worry if you can't watch live. Everybody who registers will get sent a replay of the entire event, all the presentations, all the live Q&As. It is a fantastic year this year. The faculty is the best we've ever had. In fact, the only way I think we can make the faculty better next time is to have George Gammon join it. So George, I'll be reaching out with an invite to you for that. But folks, if you haven't bought your ticket yet, go to thoughtfulmoney.com/conference. You can buy your ticket there. And if you move quickly, you can still buy it at the early bird price discount that we're offering, which is the lowest price we're going to be able to offer. I want everybody to get that lowest price who can. And lastly, if you're a premium subscriber to our Substack, look for the code I sent you. You can get an additional $50 off of that early bird price. George, like I said, it's just been a joy. Thanks so much. I think the future is going to be serving up a lot of interesting curveballs along the way, even despite
a lot of opportunity as well.
Yeah, and a lot of opportunity. But I'd like to invite you to come back on the channel anytime something's really burning bright on your radar. After you've told your followers about it, love to have you come back here and let my viewers know as well.
Absolutely.
All right, it's been such a pleasure, my friend. Everybody else, thanks so much for watching.
Both when you measure silver relative to gold in the bull markets, like 1979, 80, or 2010 and 11, silver versus gold was up in the 3.5% to 6% range, price of gold. But that would mean relative tripling to get to the old bull highs on the spread, let's say the 3+%. So, we're not right now well above 1%, but you get up to 3%. That would mean, well, I throw this number out a lot, and it's not a projection. I think you'll go way past it. But gold has had two bull markets in the last 50 years where it's gone up ninefold. Okay. If you go up ninefold this time, it means you're going to $8,500 gold, because our low is 1,050. Right. So a ninefold move in 2015 to, that's just replicating what you've done twice before. The circumstances this time are far more monstrous in terms of driving it much higher. The monetary crisis we'll face, the government debt crisis. So stopping at 8,000 is highly unlikely. But even if you went to 8,000, do a tripling of silver relative gold, silver would be at $240.
In past bull markets, silver traded at 3 to 6% of gold's price versus just over 1% today, highlighting major upside if it reverts to historical norms. While gold reaching $8,500 is only a bullish scenario, at a 3% ratio, silver could be around $240. With rising industrial demand, persistent supply deficits, and mounting global debt pressures, silver is viewed as deeply undervalued, reinforced by the elevated gold-to-silver ratio above 90 to 1 compared to its long-term 40 to 70 average. Michael Oliver, veteran market analyst and the founder of Momentum Structural Analysis, highlights that silver is experiencing its largest demand surge in decades, especially in solar, electronics, AI, and defense sectors. Meanwhile, supply is shrinking due to declining mine output and inadequate recycling. MarketWatch describes this as a potential supercycle, with severe supply deficits encouraging a powerful, bullish run. Noting this, Michael Oliver predicts that silver is entering an acceleration phase and could reach $60 to $70 by year-end, surpassing its old highs near $50 from 1980 and 2011. Adjusted for money supply growth and inflation, silver would need to be around $200 today to equal those past highs in real terms. They believe this surge will break well beyond those outdated levels. Silver has broken through long-term resistance at $34.90, surging to $38 to $39, its highest in 13 years, signaling an incredible breakout, with technical targets of $41 to $42 and potential for a larger structural rally. While silver has jumped approximately 54% from $24 this year, mining stocks remain undervalued, attracting institutional and ETF inflows. With industrial demand from solar, electronics, AI, and defense rising against tightening supply and reported deficits, the outlook remains strongly bullish. In order to receive fast notifications whenever we release a new video, please like this video, subscribe to our channel, and turn on the notification bell.
Yeah, they've already done that, frankly. Silver had a high back in October of last year at 35. It dropped. Came back up in March of this year, hit 35 again, dropped. In fact, it had a cleansing drop down to 27.50. And then came back up, and in June, it got up above 34 again. Again, not taking out the 35 plus highs. Okay, they were like 35.50 each. But at 34.90 area, we had a major momentum breakout of a structure that said, okay, silver's coming out of this congestion. By congestion, I mean, if you go back to May of last year, silver was 32.70 at a high. You could draw a line sideways through May of this year where it was either side of that level, up and down, but really just net sideways. When it got back to 34.90 in late June, we said, that's it. It's coming out of here. Whoosh, it went up to 39. Now, as typical, the price chart guys like to sell round numbers or just in front of them. So let's risk 40, okay? Okay, and now we're trading either side of 39 right now on the September contract. We think the process has already begun that you were asking about. We think the acceleration phase in silver and the miners. Now, for instance, GDX has gone from a sleepy upside pattern to suddenly it's now up to near its 2011 highs. We expect GDX not to even stop until it clears its 2011 highs, meaning get up in the upper 60s. And same with the miners in general. Silver, we think in this move, in this acceleration phase for it and it relative to gold, is likely by the end of the year to see $60 to $70, meaning those old antique highs at 50 in 1980 and 2011, which are really sort of jokes. Because one, you were up there very briefly, like days, and back down. And when you do a real valuation, the degradation of the money unit since 1980, the increase in the M2, or since 2011 even, heck, gold would probably have to, silver would have to be $200 now to just match in real value terms those price highs we saw then. So it's catching up. And I think this surge will blow past those, what we call idiot highs. And at that point, what's going to happen? The public's going to say, oh my gosh, I missed this. I got to be in it. And so I think that's when you're going to see an onrush, fairly fresh, of money moving out of the doubting stock market into, hey, I missed this. I got to be in it. The gold, silver miners, and silver. And that's when you get this gush effect, the wet bar soap effect, where everybody's grabbing it, it goes up. And this is not unusual in markets anyway, but especially in these situations. I think we're in process right now, in other words.
So when we consider that type of move, Michael, do you see this as more of a different type of new high? As you said, this was kind of a silly joke of a high, up to $50 and instantly back down. Do you see this as a possibility of being a more sustained type of new price level for these metals?
Yeah, and both when you measure silver relative to gold in the bull markets, like 1979, 80, or 2010, 11, silver versus gold was up in the 3.5% to 6% range price of gold. Mm-hmm. But that would mean relative tripling to get to the old bull highs on the spread. Let's say the 3+%. So, we're not right now well above 1%, but you get up to 3%. That would mean, well, I throw this number out a lot, and it's not a projection. I think you'll go way past it. But gold has had two bull markets in the last 50 years where it's gone up ninefold. Okay, if you go up ninefold this time, it means you're going to $8,500 gold, because our low is $1,050. Right. So a ninefold move in 2015 to, that's just replicating what you've done twice before. The circumstances this time are far more monstrous in terms of driving it much higher. The monetary crisis we'll face, the government debt crisis. So stopping at 8,000 is highly unlikely. But even if you went to 8,000, do a tripling of silver relative to gold, silver would be at $240. Is that about right? So it's the point being, when we go up there this time, also the events in the world, and in the street events, the academic notions about what works, what doesn't.
Michael also compares silver with gold in a way that he points out that silver has a history of outperforming gold during strong rallies, like in 2020, when silver nearly doubled while gold rose only about 25 to 30%. Recently, the silver-to-gold ratio fell below 1%, meaning silver was priced at just 1% of gold's value, a rare level that historically signals a strong buying opportunity. Over the past few months, silver has started to outperform again, while gold has mostly moved sideways, showing strength that suggests it's entering a new phase of outperformance. Looking at long-term trends, silver often reaches around 2% of gold's price, so doubling in relative value, while gold itself looks ready to resume its upward move soon. The best opportunities right now appear to be in silver and mining stocks, with gold likely to follow later.
That's the growth. Also, state and local government was a huge component the last time around. And usually government hiring has been a huge thing for the last 6 months. And when you look at things like transportation or factory, flat to dead, if not declining. But the overall number looks great. Okay. So it's all illusory stuff. And he finally admitted to it. That's great. So anyway.
So Michael, we've talked a lot about gold and its reaction here. Do you think we should be thinking any differently about silver's reaction, despite the setup for gold with the, interest rates and the equity markets that we've already touched on?
I think silver is participating with gold. It vastly outpaced gold in that 2020 rally. Silver almost doubled in price, whereas gold went up about $500, which is like 25%, 30% rally. Silver doubled. So into mid 2020, silver had outperformed gold on a percentage basis. But from 2020 through, the recent low, the silver spread went from like 1.5% of the price of gold down to 1% of the price of gold, even got below 1%. We divide an ounce into ounce and you find it was 1% of the price of gold. If you go back through 50 years of history and look at that spread relationship, you'll see that when you get down to the 1% level, it's time to buy silver. Okay. It's meaning it's dirt cheap. It's not going to go to zero versus gold. Okay. But then the technicals turned. And so over the last 4 or 5 months, you've seen silver outperform gold. Like, for example, back in April, gold hit 3,500. It's gone sideways. April, May, June, July, now, August, 4.5 months of comatose, but steady sideways. They keep trying to sell it, but then go down. But it also doesn't go up. So it's had a sideways correction, which is, by the way, not the way gold ever tops. Okay. During that time, silver's gone up sharply. Okay. We assess technically that silver's now at a point where it's going to outperform gold fairly dramatically. If you go back over 50 years and look at that same spread, you'll see the number of years it got up to at least 2% of the price of gold was like 21 of those 50 years. So it's not abnormal at all. So from the recent low of 1% to 2%, meaning silver could double in relative value to gold, probably over the next year. Wouldn't be surprising me by the end of the year even. Same is true with the gold and silver miners. They're back into outperform mode versus gold. And if you'll look at gold sideways since April, look what GDX has done, vertical. Okay. So I think those parts of the monetary complex are the place to be right now. Silver, the gold and silver miners. Gold will re-engage, and I think it's going to re-engage probably later this month or next to the upside, where people say, oh, it's awake again. But silver and the miners will be the place to be.
Silver appears to be entering a powerful new bull phase, supported by historic undervaluation relative to gold, record industrial demand, tightening supply, and strong technical momentum. With prices breaking out to multi-year highs and miners still undervalued, analysts like Michael Oliver see silver leading the precious metals complex, potentially reaching levels far beyond its old peaks. This makes silver and mining stocks some of the most compelling opportunities in today's markets. If silver truly enters a supercycle, how high could prices realistically go beyond the $60 to $70 near-term targets? With mining stocks still undervalued, should investors focus more on physical silver or silver equities to capture the upside? Please leave a remark in the section below with your ideas. Please remember to subscribe to receive updates, and if you find this helpful content, kindly give it a thumbs up. We are grateful that you joined us on this journey.
Gold's up almost 40%,
yeah.
But gold stocks have more than doubled. So and so people have made a lot more money.
Yeah.
starting in April, because even the first quarter, the gold stocks didn't even move. It started in Q2, but I don't even think gold stocks have caught up to $3,000 gold yet, let alone 3,700. And we could easily be at 4,000 by the end of the year. We're going to get into a stage, maybe next year, with gold well north of 4,000, maybe 5,000. Maybe the gold stocks double again from here. But at some point, they're going to get on the radar of the average portfolio manager, and they're going to start buying. If silver hits 50 when gold's at 4,000, and I think that once silver gets above 50, I think it's going to take off. I think the move from 50 to 100 will be relatively quick.
Gold has climbed nearly 40%, but gold mining stocks have more than doubled since April. The bank raised its 2026 gold price forecast from $3,700 to $4,000, citing strong central bank demand, possible U.S. dollar weakness, and expectations that the Federal Reserve will ease rates. If gold pushes above $4,000 or even $5,000 next year, miners could double again, eventually attracting big institutional investors. On the silver side, once it breaks $50, in the near to medium term, especially if industrial demand and investment flows remain strong, the run to $100 could happen much faster. Peter Schiff is a well-known economist, investor, and outspoken critic of U.S. monetary policy. He recalls that earlier this year, gold mining stocks were so undervalued compared to gold itself that they offered far better upside with minimal downside risk. Goldman Sachs sees gold $4,000 if investors shift more into metal. Their baseline is $3,700 in 2025, $4,000 mid-2026. If there's a big dollar asset exit, gold might go toward $5,000. Jeffries says gold mining stocks have underperformed despite gold's big gains. Many miner valuations still reflect much lower presumed gold prices. Newmont has already doubled this year but still seen as undervalued compared to what gold's price implies. Free cash flow growth, share buybacks, etc., are driving analyst upgrades. Peter believes central banks continue buying aggressively to shed dollars, making gold an increasingly vital reserve asset. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
$3,000 an ounce for gold when I can buy gold in the ground that's still valued at less than $2,000. In fact, way less than that. I thought that if you looked at what you were paying to buy these gold mining companies, that gold still in the ground had never been so cheap relative to gold above ground. So it wasn't that I didn't think gold was going to keep going up. I just thought, why buy it when they're giving away these gold mining stocks and they're so cheap, and the downside I thought was so minimal? It made a lot of sense. And, now I think year to date, gold's up, almost 40%, but gold stocks have more than doubled. So, and so people have made a lot more money, starting in April, because even the first quarter, the gold stocks didn't even move. It started in Q2, and the whole doubling was basically in the last maybe 6 months. Didn't even take a whole year to double. And so, but I don't even think gold stocks have caught up to $3,000 gold yet, let alone 3,700. And we could easily be at 4,000 by the end of the year. So, I'm not telling people to stop buying physical gold and silver now, because it's not that obvious, but at that moment in time, to me, these mining stocks were so ridiculously cheap that I couldn't see putting any money into physical gold when you could just buy these miners. I just did not see the downside risk, and I thought there was huge upside potential. Now we've realized some of that upside potential, but I think in the scheme of things, these stocks are still very cheap. If you look at the PEs of the big gold companies, they're very low compared to historic averages, compared to the market multiples. The investors are not in. I mean, they still had net liquidations all year out of GDX and GDXJ, these gold mining ETFs. Nobody talks about these stocks. Nobody owns these stocks. Newmont Mining is the best performing stock in the S&P 500, yet it's probably the stock that's least owned in the S&P 500. They're going to make nothing but money for years to come. They are producing a product that everybody needs, whether they realize it or not. I mean, the central banks are huge committed buyers, right? They're not going to stop buying gold because they're not going to stop divesting of dollars. And they keep earning dollars, right? Because we're hemorrhaging dollars due to our trade deficit. So not only do they have to get rid of the dollars they own, they have to get rid of the dollars that they keep getting. And so they're going to keep buying gold. And as the price of gold rises, it's just going to suck more central banks into it, because the central banks that aren't buying gold are falling behind the ones that are. And gold is becoming increasingly more important as a reserve asset, not just because central banks are buying more of it, but because the price of what they own keeps going up. And that means that the value of their gold as a percentage of total reserves keeps going up. And so, there's going to be a FOMO in central banks to get into gold. And they're just, they're price agnostic. I mean, they're not going to stop buying because the price goes up, because they're just trying to get rid of their dollars before the price goes down. But at some point, the investing public is going to join this party. I mean, I think to an extent, some money is already coming in, and that's why the gold stocks have had the move that they had. But this is just the tip of a huge iceberg that we've seen. And so far, the buyers have been patient, and they've been buying on the pullbacks, and there hasn't been any crazy up days. There's no real euphoria. And I still see sharp corrections like what we're having today. Gold doesn't even go down, right? Yeah. And all of a sudden these stocks are down 3 or 4% just because people are afraid, oh no, this is it. But the minute gold doesn't go down and goes back up, then the buyers come rushing in. The coast is clear. But we're going to get into a stage maybe next year, with gold well north of 4,000, maybe 5,000. Maybe the gold stocks double again from here. But at some point, they're going to get on the radar of the average portfolio manager, and they're going to start buying.
Peter highlights that smaller gold companies with proven reserves but no production yet offer strong value, as larger producers flush with cash may buy them out rather than fund risky exploration. Gold is up 30 to 40% year to date, with miners outperforming but still undervalued, leaving room for further gains, M&A, and institutional inflows if prices hit $4,000 to $5,000. Central banks remain steady buyers, reinforcing long-term demand. Juniors with proven reserves but no output look attractive as takeover targets for cash-rich majors. Silver faces structural deficits from industrial use and ETFs, making it highly sensitive to new demand. $44 to $50 is the next target, with a possible rapid surge to $100 in a blow-off rally. Peter predicts if silver breaks above $50 while gold hits $4,000, it could quickly surge toward $100, unleashing pent-up demand, since silver is still below its 1980 high while gold has far surpassed its own. Let's review the interview.
There's a lot of smaller companies that aren't as speculative as you think. I mean, if you're talking about a pure exploration type company, because you don't know what they're going to find. Maybe they find nothing. But there are a lot of very small companies that have proven reserves that they just haven't raised the capital to dig up yet, right? They're at the earlier stage. You're not at the exploration stage. Although they may be exploring for more, but they have provable assets, and they just haven't developed them. So they're not, in production. They're not generating any income. And I think there's some incredible value there, because I think these companies are going to get bought up. I mean, it'll be a much friendlier environment to raise capital in the future, and they will be able to raise capital to build out these projects. But I don't think they'll have to, because I think the bigger companies that really have not been investing much in exploration and development, they've just been paying down debt, and now they're buying back stock. I think they're just going to have so much cash that they're generating, they're going to have to do stuff with it. And I think it's going to be cheaper to buy out other companies than spend money on exploration and development. I mean, because you roll the dice on exploration, you don't even know what you're going to find.
True.
Why do that when you could just buy up these companies and get their whole book of business, right, on the cheap? So I look, there's just going to be so much money made, I think, in the consolidation of this industry, which I think is going to happen before there's any really major increase in exploration and, of new projects, which is another reason, the price is going to keep going up.
Yeah.
Because there's not going to be, it's not like when gold is $5,000 an ounce, there's suddenly going to be all this extra gold that's being mined. It's not going to be there. Yeah, there may be some more marginal supply. Maybe Americans will start selling off their jewelry at $5,000 gold, to pay the grocery bill, but that's not going to make much of a difference in the scheme of things. And so there's not going to be a lot of new production. Yeah. And, one of the sources of supply used to be central banks selling. Mm-hmm. Central banks are not selling. Again, they're buying, and they're going to keep buying, especially these emerging market BRIC nations. They still have, very small percentages of total reserves in gold. Even though they've been buying, they have a lot more to buy. Yeah. It's just that the major central banks, like, in Western Europe, United States, where we still have a lot of gold, but we haven't been buying, right? The United States hasn't bought any gold. No. I mean, we're thinking about buying Bitcoin. That's how dumb we are. There isn't a lot of silver out there relative to the demand that I see for it in industry, but silver is just cheap, and it's cheap relative to gold. And that's the best barometer of whether something is cheap or not, is look at it priced in gold, and you can still get a lot of silver for an ounce of gold. And even at $50 silver and $4,000 gold, that's still 80 to 1. Yeah, that's still pretty cheap. Yeah, if silver hits 50 when gold's at 4,000, and I think that once silver gets above 50, I think it's going to take off. I think the move from 50 to 100 will be relatively quick. I mean, it'll be a lot quicker than the move from 30 to 50. It may even be quicker than the move from 40 to 50. But I think it's going to unleash a lot of pent-up demand. I mean, why shouldn't silver be double its 2000 or 1980 high? I mean, gold's 1980 high was 850, and we're quadruple that. So, I mean, and silver is still below its 1980 high. And so, there's not that many things that you could find that are cheaper than they were in 1980. Silver's one of them. I think it's very cheap. And other precious metals are cheap too. Look at platinum. I mean, compared to the price of gold, and platinum has already had a big move this year, but it's still pretty cheap. So I think we're finally starting to see some of the other precious metals moving, but silver has always had a stronger monetary correlation with.
Would central bank purchases result in a permanent floor on the price of gold and silver? Before the next step higher, will institutional investors finally see the benefits of mining stocks? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.
Right now, silver looks weak compared to gold when you go back to 2011 high, but what's been going on for 5 months is a lot more strength in silver. I think that's going to continue, and I think it's going to get explosive. And I think we're going to look down in, a couple months, and we're going to say, oh, wow, finally, the beast is out above its all-time highs. It's like 60 or 70, which is sort of a broad working target we have for the next surge. If gold just stood still and silver went to, 2% of it, silver would be $70 or so, But gold will be going up there in that time. It's just that silver will be outpacing it. So we think right now the place to be most focused in terms of holding a position, we said that about several weeks ago, and sure enough, bang, we're up through the highs again. I think the game is started again. I'm not quite sure where gold's going to go in this particular surge. Ultimately, it may go to 10, 20,000.
Silver is gaining momentum and looks set to outperform gold, with analysts expecting it to break past its old highs and potentially reach $60 to $70 as it catches up. Even if gold held steady, silver could rise to around $70 at 2% of gold's value, but since gold is also climbing, silver's outperformance is likely to accelerate. With gold's rally restarting and long-term projections pointing as high as $10,000 to $20,000, the strongest focus right now is on silver within the monetary metals. Michael Oliver is a seasoned market analyst and the founder of Momentum Structural Analysis. He explains that gold has spent the past 5 months consolidating in a sideways range, frustrating skeptics who expected a major correction. Instead of falling, gold held firm and is now breaking above $3,500, signaling renewed momentum. This pause acted as a cooling-off period, setting the stage for the next surge higher. Analysts suggest this rally will be powerful but not the final peak, with potential targets of $10,000 to $20,000 in the long term. Silver and gold miners are also showing strong outperformance, with silver expected to surge towards $60 to $70 before any meaningful pullback. Unlike past rallies, this move is supported by deeper global and macroeconomic shifts. The dollar index has been flat for nearly a decade, yet gold has more than tripled, showing that other forces are driving demand. Weakness in treasury bonds, signs of a topping stock market, and risks of a sharp Bitcoin decline could all funnel more money into precious metals. With these pressures building, gold and silver may see explosive upside before year-end, as investors rush to safe havens amid mounting financial instability. Before we begin, please subscribe and enable the notification bell so you stay up to date. We'd love to hear your thoughts, so please share them in the comments.
Well, gold's momentum is positive. In the 5 months of horizontal price action we've seen, it allowed all the doubters, and there are ever doubters out there. It's got to correct. It's got to go back to 20, this level or that level, some old high, and it didn't do it. They sold into it repeatedly. Like 3 times it got up to 3,500 or 3,450. Right now we did trade above 3,500 today, by the way, using October gold. They couldn't break it. They sold it and they kept getting these $100 and $150 pullbacks, and then bang, you're back up again. So I guess they got taught a lesson that this is not some beast that has to correct big time. Instead, it had a correction by standing still for 5 months. And our work on momentum and clockwork of momentum, meaning often momentum swings can be measured on certain of our metrics in terms of how many months have been spent trending up on the oscillator or down on the oscillator. And for that 5 months, we've had a corrective downside process in momentum as it cooled off while price went lateral. The clock is old. We said that about several weeks ago, and sure enough, bang, we're up through the highs again. I think the game is started again. I'm not quite sure where gold's going to go in this particular surge. Ultimately, it may go to 10, 20,000, okay? But we're focused right now on MSA on this issue. This particular surge will not end the bull market, but it will be dramatic. And therefore, if you're invested in the monetary metals, particularly the silver side and the gold miners, which are now also outperforming gold, we're looking for points to take profits. But I'm going to tell you that in the case of silver, we're not looking for it, frankly, until we get to 60 to 70. Because we've blown out the idiot highs, which means, pardon me, those who missed the move had ignored it and doubted it, will suddenly say, well, golly, I got to be in that, okay? And then you get further gush of money into a fairly small market, which could easily goose it into that zone, and we've got some reasons for that zone. But ultimately, there could be a correction up there, not the top. So if you're fully invested, unleveraged, ignore what I'm saying. Because I think we've been arguing that this move in gold and silver is different from the prior ones. This time, I think there's more fundamental and macro technical events going on globally and in major asset categories, not just a stock market top, which I think has been making since early this year. It's a widening top, but it's a topping pattern. But in certain other areas like the breaking of the dollar has not been a factor the dollar index, when you measure it versus euro and yen primarily, that's 70% of the dollar index. It's been sideways since 2015 when gold made its low. It's trading around 98 right now. We're trading just below 98. So yeah, it's been above it and below it since then, but 10 years it's been net lateral. Well, why is gold not net lateral? It's triple and a half. So you don't just look at the dollar for driving gold, but it will help because it's now entered what could be a dynamic bear market. And dynamic on the downside could, in fact, be further wind for gold. Then we go to the T-bonds. T-bonds are usually an alternative. If you have a perception of a weakening stock market, people will tend to move money into T-bonds as the alternative. They're not. T-bonds are very anemic. They're very weak. They're behaving more like the stock market in terms of when they make lows and highs. And right now, T-bonds, as we speak, are not far away from some levels that if they break below, you could end up getting a little mini bond market event, which would spook the stock market. Anyway, there's a lot of these factors out there, including Bitcoin, I think, which is in a potential crash situation. We've been saying that for a few months. Not that we're there. The trigger numbers are still below us, but if you hit those trigger numbers, that could suddenly become an off-the-sideline type, oh my God, where did that happen? How did that occur? And it will have wave effects because the financial institutions are now so heavily involved in crypto. So anyway, these events are out there percolating, and I think they're going to occur. And when they do, that could create further upside panic in the monetary metals. And I think we're going to see that between now and the end of the year, possibly sooner than that.
Michael thinks that gold's rise since 2015 can't be explained by the usual drivers like a weak dollar, falling stocks, higher commodities, or bond shifts. Instead, it reflects something bigger, deep distortions created by government control of money. These forces are converging, setting up a cascade that could spark central bank panic. Silver is expected to break past its old $50 high and surge towards $60 to $70, drawing in late investors before any correction. Still, that would only be a pause, not the end of the bull run. Historically, gold has delivered two eightfold moves in the past 50 years, and repeating that pattern today would put it near $8,000. Analysts argue this wouldn't even be unusual. It would simply mirror past cycles. Michael predicts that if gold does reach those levels, silver could climb dramatically as well, possibly reaching 2% of gold's price. Commodities may follow along, but the real fireworks are expected in gold, silver, and mining stocks, making the coming surge both dramatic and highly concentrated in monetary metals. Now let's revisit the interview.
Explain, we showed in the weekend report the chart of gold since 2015, and there's this upward plotting action and then it's accelerating. And you say, well, what caused that? And it wasn't because it was declining stock market, which helps gold. If you go back 2000, 2002, 2007 high in the stock market to 2009, gold went net up. There was one break in there, but it kept going up. But we don't have that right now. So it's not the weakening stock market yet. It's helping gold, so we will, because money will move. It's not reflected by the bond market. It's not reflected in commodities. The Bloomberg pullback from a high at 140 to either side of 100 back in 2022, dropped in 23, and then went sideways, has been dull for a couple of years. So it isn't commodity prices, so-called commodity inflation. You look around, and it's not the dollar. The dollar has been Deadsville. It's recently started to drop, but it's not precipitous yet. So how can you explain this? Well, because there's something bigger going on. It's not merely one of these things. It's a combination of things, largely built around the distortions created by government monopoly over money. And gold knows this. And later on, you'll see the headlines and you'll look back and say, oh, now I know why. But don't look for the reasons why to be in your face as it's doing it. Look for them later. Too late to be joining. Okay, not too late, but you're late. Okay, already you're late if you're not in. So that's why I think things will change more dramatically this time, is that all these factors, not just one of them, all of a sudden now we have a lot of factors that are at the point of cascade, which would create what? Total panic on the part of central banks.
Well, for silver, I think we'll take out the 50 high, and I think you'd at least go to 60, 70. And at that point forward, once we cleared that high and sucked in a lot of late money, grabbing it, a wet bar of soap stuff, there'll be a point to take some profits on a trading basis. Not that the move is over, okay. But if you historically, and I've said this over and over, and I'm not predicting the price because I think it'd go way beyond it, gold has had a couple eightfold moves. 1976 low to the 1980 high, eightfold gain. 2001 lows, 2011 highs, eightfold gain. Well, we started from a low at 1,050. You want to do the math? Somewhere between $8,000 and $9,000. You would simply be reflecting what it's already done twice in the last 50 years since the U.S. government legalized it. Okay, so to go to $8,000 now and gold would simply say, oh, it's doing what it did before, which isn't even abnormal. But what we're talking about is something far more abnormal. And therefore, you could go way beyond that on a fundamental or technical basis. But right now, even just echoing what it's done twice before, the same dimension move, you go to $8,000 gold wouldn't shock me one bit, particularly when these other factors start to come into play, which I think could be in the next month or so. Anyway, so that would give you an idea. Well, gold maybe go to 8,000. Well, that's just, again, it's just doing what it did before. Is that a top? No, probably not. But it's a statement of, goodness knows where silver might be then. You want to put silver at 2% of 8,000, okay? Anyway, that's what I think we're shaping up for. And I think it's going to be dramatic. And it's going to be very isolated, very focused in monetary metals and their miners. I think to some extent commodities will coattail, not lead, not cause, but coattail gold in this up move, much like they did in the late 70s, where commodities coattailed the bull market to the 1980 peak in gold. They didn't match it in terms of upside, but they did coattail it. And I think we could see that again. But I think it's not outlandish to think of $8,000 gold. Now, again, what does that mean? Well, a little more than doubling where you are now. Is that a big deal? I don't know.
Michael Oliver highlights that both gold and silver are entering a powerful new phase, driven not by traditional market factors but by deeper systemic distortions in the global monetary system. With gold potentially targeting $8,000 to $20,000 and silver set to surge past its old highs towards $60 to $70 or more, the precious metals market may soon witness one of the most dramatic bull runs in history. This rally, fueled by weakening confidence in traditional assets and central bank actions, suggests that silver and gold miners could offer some of the strongest opportunities in the coming years. If gold were to reach $8,000 or higher, how high could silver realistically climb relative to gold's value? Do you think central banks will intervene directly in the silver and gold markets if the rally becomes too explosive? We'd love to hear your thoughts in the comments. If you found this video helpful, give it a thumbs up and subscribe for more updates. Thanks for joining us on this journey.